Hello everyone and welcome back. Well, we often get asked the question of which is the most important market to be watching in markets, and many of you will always come up with the same answer. Well, it's the US stock market, of course, the S&P 500. Yes, it is, but at the same time, there is a market that is even more important that most retail traders don't look at. And yes, I'm speaking about the bonds market, obviously one of the biggest markets in the world and often overlooked. In today's special edition, we'll be looking at the bonds market and looking at a very important concept, and that is what the bonds market is telling us versus the Federal Reserve. This can absolutely be a game changer in your investment and trading journey, and hopefully you enjoyed today's video. We'll see you soon. This is sure to be a good one. Well, welcome back everybody to the Daily Show, and of course this is where we talk about stocks, commodities and cryptos usually, but today is a special edition of stock markets, bonds and massive rotations that are happening underneath the hood by Wall Street. They're getting pretty sneaky and it looks like they're prepping for some kind of really bad price movement later on in the year. We'll talk about that more soon. Let's discuss now Fed tightening. So every single time the US market has ever seen over 5.5% inflation in terms of the core number, the only way to combat that has been to get the interest rate, that is the federal funds rate, above the level of the inflation. Now, at inflation as the time of this recording being over 8%, that would mean that we usually 100% of the time to beat inflation have had to get it above 8%. Of course, with the money printing and everything, that is not possible to do right now. And I think this will be the first time in history. Most people that I've talked to, including the big bonds managers, the billionaire bond managers that I've discussed this with, all believe we cannot get to this level. So therefore, it's probably the first time it's going to get violated. But there is something else that's very interesting. And not only are we seeing a level of consensus with the Federal Reserve having to tighten at an incredibly fast rate, but then on top of that, there's something interesting in the bonds market that's saying that then they'll be forced to do a cut immediately afterwards to try to support the US economy. This is not so much becoming a discussion about inflation anymore as it's becoming a discussion of how much damage is the US economy and world economies going to be in terms of having to raise these rates so fast. So the cut here, interestingly enough, 5 of the 7 times that they've cut these rates, they've caused recessions. So when they hike and then they cut, they'll cause a recession. So as we know, it's not so much a question of whether we have a recession, we most likely will. It's almost, I think, myself personally, I'm going with yes, we will have one the next couple of years. But the other thing is, how many do we have? Do we end up having what Volcker did, which caused 2 recessions in the US very quickly surpassed by each other? Let me know in the comments down below what you think about that. Let's look at the German trade balance here. Of course, we always talk about the US, but Germany is an incredibly important country in the world. And obviously it's the pivot for Europe. German trade balance, first time in a very long time, goes negative. Not good for Germany. And of course, this is thanks to the massive cost of energy and everything else. So basically, the balance is starting to turn negative. It's a massive crisis that's happening in Europe, and we'll have to continue to watch Europe because it's really the market that is most susceptible to damage. And that's why we're seeing such strong US dollar right now. For anyone that hasn't seen this chart, take a quick pause here on the video and have a look at it. It's got some great stats for the July month ahead. But I want to talk about asset management flow because this is where things really change. And we've seen this now really as a phenomenon pretty much through the 2021 mid kind of point around July all the way to now. So have a look at this July. This is the net asset management purchases going forward from that period of time. Notice the trend. The trend has been they are still purchasing, but they are purchasing at incredibly low rates. The reason why that is, they're adding to shorts. So there's a lot of asset managers that are actually heavily shorting the US market. As the market goes up, sometimes it's what we call a bull trap. So obviously we're in a big declining market, in a technical bear market. As markets then go up, what happens? Well, sometimes asset managers start to short, and leverage traders, which are more important to look at as well, start to short. So as it goes up, you might think, oh, well, they're coming with me. They will be to a degree, but what they often are doing as well, certain parties, are adding to their short positions. And if that happens, it's a very worrying sign. I'll just point to a few things that have happened before. Obviously, in March into April, what happened? We had a rally in the market. We here on the channel, we were talking about it. We obviously thought it might go a little bit longer in terms of that rally. Timing is sometimes difficult. And then it was going to go down heavily. They were adding net shorting at that time. So of course, when you see that, yes, the asset managers were purchasing a little bit, then they dropped off and then they started dumping into the short. But look at the leverage traders. These leverage traders were going ballistic. They were placing huge amounts of net shorts. We're seeing a similar number of net shorts here at this stage. So if the market now rallies and we see this number go down on leverage shorts, is that going to be worrying here in the markets? Absolutely, it will be. And it just shows you that it's very important to understand what's underneath the hood, more so than just anything else. Like, we need to know not only the price action, but does it agree with some of these big funds? So always remember to just follow this channel, because we will be covering this a hell of a lot over the next coming months. I think that the back end of 2022 is going to be a rough year. Let's now talk about US dollar and its relationship with the US stock market and markets around the world. We're seeing a huge amount of pumping into the US dollar. Whenever the US dollar goes up, usually at the moment, the stock market is going down. This is the S&P 500 here on the orange line. When the US dollar goes up, the stock market goes down. When it goes down, the stock market goes up. So this is a clear correlation to just allow you to make sense of the madness that's out there at this stage. Let's now also talk about yields. This is where bonds come into the market. Here we have the US 10-year. You'll notice that we have this massive demand zone, which is sitting around that 2.8%. We almost hit it on the Friday session, and now we've rallied a little bit off that. But if we break this, it's going to mean a lot of things. It's going to mean that basically we have the chance of a huge amount of inversions, which we'll talk about soon too with bonds, but also we probably have a weakening US economy, and the market is starting to say, hey, guess what, Fed? You think you're getting to these levels? We think that you're going to have to go up and then back down. What are the stats to do with that? 5 and 7 times US recession. So if we were not already in a recession at that point, probably going to cause another one if we do come out of it very quickly. US dollar, as you can see here, is kind of very, very strong. This is a 1 hour chart. Look at this holding pattern that we're starting to appear in. A lot of people are looking for this for what we call a Wyckoff setup. So a Wyckoff setup usually would be something like a big spike up and then a huge start pulling back, and we'd see a move from cash into the markets. That would be a great sign if you were bullish markets. But if you see the stock market going up and at the same time the US dollar is going up, it's a bad sign. Of course, that's not really the strongest thing in the world, and it means that people are still incredibly fearful. Let's now move over to the bonds market, and this is where things get really interesting. So we'll start here in December of 2022. So that's this year. What is happening? Well, of course, the Federal Reserve is planning to raise rates at a substantial rate. In fact, the market believes the Fed in some ways here. The market says, oh, we think that you can get the rate to 3.3%. At least that's what you're telling us right now. Now, imagine if we are in December and we're at 3.3%. Do we think that's going to be doing a lot of demand destruction? Of course it is. The US economy is going to be absolutely in pain at that kind of level rate. So this is what the bonds are currently telling us about the December 2022 rate. They believe the Fed will try to raise to beat inflation. That's their number one thing that they're trying to do right now. And you can see the substantial movements of this throughout 2022 so far. Let's now move over to April 2023. You can see how high it was. It was sitting at 4%. Now it's come back down to 3.4%. So again, what's it showing you? As another increase potentially in the Federal Reserve's rate hike. So this is now in April 2023. But as we go through 2023, check out this, 3%. So between April and September of 2023, we have a cut, or we have maybe 2 cuts that have had to come back in. So the rates have gone from being really high all the way back down. And this is where the market's starting to say, well, wait a second, you're causing so much pain in the US economy, you're going to have to cut rates in 2023, mid to late, to even try to support the economy at that point. Now, we know that usually causes a recession, but at the same time, it also could cause the Fed to have to come in with monetary policy. I think what the market's saying in many ways is that 2023 could be an amazing opportunity. If the market continues to fall here for 2022 and we end up getting a really bad end of the year, and then the Federal Reserve is forced to cut rates, what else might they do? They might turn on the tap again. Remember, the Fed can never really leave this market. If they can deal with inflation, they're going to have to come back in on these markets. What do you think in the comments down below? Do you agree with this concept? Here's what the bonds market says about December 2023. And you'll notice here we have a market that's basically again in decline. Effectively a market that has gone back down, and it's showing at about 2.6, 2.8%. So that's showing even more cutting may be necessary. And then we go into 2024 and the rate is now sitting even lower in some ways, sitting around 2.625 in terms of this rate. Now it's not updated, but that's where it's sitting. So it's saying again, we hike, we overhike, and we have to cut. And that's not what you want to know about the US economy right now, because of course that's a very worrying sign moving forward, but it could be also an amazing opportunity if you're patient enough in investment terms and even trade terms, if we can find the bottom thanks to this kind of concept that the bond market's telling us. What if the market then continues to go down and you're seeing that become even more and more likely, and then you start to see the Fed come in? Well, we all know what the market's going to do when the Fed comes back in, if they do, which I think is inevitable in this kind of environment. All of a sudden, you're going to see a huge amount of equity raise, and that's going to be massive. Here's another kind of comparison. I think this is a huge chart here. This is IEF, the 710 Treasury bonds versus the SPY. Now, you'll notice that when this is spiking, we tend to have kind of like a weakness in the market. 2014, 2016 was a weak time in the US market. When it then went and broke below, we saw an incredible time for equities. And then, of course, we got into 2018, 19, and we started sidewaysing. And then we got really fearful around, of course, the pandemic. And then we drop straight off. When this is going down as a ratio, it's usually a bit of a go signal that says, yes, people love stocks right now and the stocks are going well. Well, we're not quite seeing that for 2022. You'll notice it's back at these highs. So an interesting point, if this starts to break out, probably a bad thing for markets. So continue to watch codes like this. We will be doing it. The other one that I like to watch is SPY versus XLP. So this is the S&P 500 versus the consumer staples market. And if you have a look at this on a chart, you'll go, wow, look at this thing. So what this is telling you often is when the market is defensive and when the market is in growth phase. That is, it's feeling very, very good. From around this point here, so around 2016 all the way to 18, the market loved itself. It was like, everything is good, everything is green. It makes sense. What did we see at that point? Tax cuts. What else did we see? All sorts of lowering of yields, and then it was kind of raising back up, and it wasn't looking too good, but it was mostly a lower yielding environment and tax cuts, which helped buoy the market. Now, in 2022 so far, what have we had happening? Well, 21 in November, it all started going bad. We saw the market start to rotate as a ratio into staples. Now, when the market rotates into staples, what it's telling us is that the big stock makers, the big stock pickers, they're going into defensive mode. And when they go into defensive mode, you have to pay attention. You always have to pay attention. Defensive mode is not good mode. It means they're worried about the economy. We must always think of it from a big fund manager perspective. They have a percentage of cash and a percentage of bonds and a percentage of stocks that they must be holding. The average portfolio is 60-40. 40% bonds and cash, 60% obviously in the market. They have to be invested. If you have to be invested in a down market, what are you going to want to do? Buy staples. That's what they tend to do. So of course, this is why we're in this predicament. A very interesting chart, and hopefully that helps some people better understand these markets. Semiconductors versus S&P 500, another sign that growth is slowing, and the best sector in the markets realistically for many, many years. I mean, this is a weekly chart here. Look at this gain. My goodness, it's so good. This is a bad ratio. It broke through last week towards the downside. I don't like that. Like semiconductors getting smashed like this is not necessarily a great sign for any recoveries that we see in the markets right now. And that brings us to the S&P 500. If we were to take the median, the mean, and all of those things to do with pullbacks, what numbers do we end up coming out with? Well, we come into this area in the box. So this area in the box basically gives us our standardized kind of levels. If we also, and you'll notice I've got a second level down here, go with kind of a few other numbers, we end up getting a 37% drawdown. So basically, we either come back into here, highly likely if we get a recession, the average median kind of level, or get back into here, which again is a very, very low zone. Now imagine if this was happening and the Federal Reserve came back in and you were a patient person and you saw the Federal Reserve come back in and say, hey guys, we're going to cut rates. We've dealt with inflation. Don't worry. Inflation is not our problem. We actually destroyed the economy. So our new problem is we have to pump it up. And I don't doubt they'll do this. They're going to be politically pressured at some point to try to do this to save what is a very fragile system out there, especially in the Eurozone. There's so many cracks, so many fractures in this market right now, but I do hope that some of those things have helped you better understand the current rates market. Obviously, we have the current rate, we have the 2-year rate, which you can look at and see, but what about the rates underneath that? The bonds market's telling us big bull in terms of hikes, then huge cuts needed to support the economy. Those huge cuts could be a very big ticket sign in terms of showing us that the bonds market is believing that at some point around that period, the stock market could also be turning in a big way. So that's very, very interesting stuff. Speaking of the more short term, as I know many of you are traders and day traders out there, this is the current market that we've got coming into the Tuesday open after, of course, the time of this recording, which if you're watching right now is the day before or just on the day of the July 5th. So basically we'll have this market opening after a long weekend. Technically, the US stock market futures are bulling. They're breaking through our important 38.40 area. Now we need the real market to get through here. We were super duper correct as a community last week with the 37.40. I don't know why it's these 40s either. It just seems to be. We had the demand zone. The demand zone held. Congratulations to anyone in the Discord community, whether it's our private community or even the public one. You guys were on it. Just links in the description down below if you're interested. But we basically saw this rally through. Now, if we get this closure above here, above this 38.40, I think it's a pretty good sign that the market is going to want to continue to bull up. And we've discussed this a few times because when we go over to the SPX code, there's a few things that we've left behind here. The first one is a huge gap. And there's a huge gap here as well. I don't think we'll fill that one just yet, but there's a huge gap left here because the market was so inefficient and so fast at shorting off due to, as we know, all of the shorts that Wall Street was placing throughout that time. Now we still have the shorts, but maybe they'll let it through to the keeper. Maybe they'll allow the market to go up, keep placing shorts, which of course we'll be updating you on, and then potentially hitting our nice trend line, which is here. And of course, that's all going to coincide with certain things such as fibs, etc. So the market at this stage should hopefully be able to go to the bullish side. If it does end up breaking underneath these wicks from last week, though, that 37 kind of 40 zone, I tell you what, we might have to watch out. And the next zone after that is going to be around 3,500, which the reason why you get 3,500, I think it's plainly obvious to most of you out there. The previous resistance, the 200 SMA as well, also there, and a whole bunch of stuff. Let's also take a look at the options for the week ahead. Now, this is the options Friday expiration. Jobs numbers, all sorts of things coming out this week. Check out this. Why are there all these calls sitting on 410? I don't know, but it's certainly a bit of a blocker. We found the blocker last week. We were pretty much correct on that as a community, so well done, guys. But we do have this 410 call wall kind of sitting here. I doubt the market can get through that this week. And yeah, it's going to be very important. For anyone that hasn't already, come and follow us over at FX Evolution on our Twitter as well, and definitely consider following us there. And remember, this is a big week in terms of news. We have the cash rate announcement for the RBA, which is coming out just after this video, and that's going to be a big one. We're probably expecting the cash rate to go up 50 basis points. And while it's not America, it's another big central bank doing the raise. Then we have the FOMC meeting minutes. That'll be interesting. JOLTS job openings and the big kahuna news coming out on Friday. Yeah, I said big kahuna. And the reason why is the jobs numbers in the US. Non-farm employment change numbers, 8:30 a.m. So 1 hour before the US stock market opens. It's going to be a big number. I doubt it's going to be very cool or very good. Let's find out. Everyone now looks to jobs moving forward. And although it's a lagging number, I still think it's going to be a determining factor for the Federal Reserve moving forward as well. Thanks so much for watching. If you enjoyed today's video, remember to, of course, give it a thumbs up, subscribe, guys, and we'll see you in the next one. And also a big shout out to all of you. We're getting close on 100,000 subscribers, and I want to thank each and every one of you. I hope you had a great weekend if you're in the long weekend in the US. And of course, look, let's hope that the markets do whatever that you want them to do so you can make a bit of money. Catch you later.